Cash flow, cash flow, cash flow, right? How many times have you looked up any sort of blog, podcast, video about real estate, basic real estate investing, and all the harp is always about the cash flow? Now, don't get me wrong, it is an absolutely critical component to a successful real estate deal, right? You certainly need cash flow because without cash flow, you're gonna be upside down and you're gonna lose your shirt. But what most people don't realize is that cash flow really is not where the money is made in real estate. And I'm gonna explain that in this video. So let's get after it right now. What's going on, guys? My name is Lior and welcome back to my channel. Now, before I talk about this concept of don't be a cash flow chaser, which I am very passionate about, talk about this all the time. Super quickly, guys, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button for me. I'm putting out tons of new videos every single week talking about all different facets of multifamily investing, syndication, raising capital, and everything in between. So if that's the kind of content you're looking for, make sure you subscribe to my channel. So as I said in the intro, right, one of the biggest things that people harp up with real estate is creating cash flow. Now, I get the concept of creating cash flow, right? It is, like I said in the intro, it is critical. And I truly do believe that having multiple streams of income, all that is absolutely crucial to building wealth. But that being said, I think there is a major overemphasis on chasing cash flow when you're specifically looking at analyzing and investing in multifamily or even generally real estate deals, right? And part of this reason why I think this happens is I personally call this the Biggerpockets myth, right? Because Biggerpockets has really just harped on this concept over and over again for like a decade and has made people literally just think about this one target metric for a real estate deal. And if it's there, fantastic. And if it's not, don't touch it, right? So I call it the Biggerpockets myth. And I think it has caused a lot of confusion for people as to where the money truly is made when investing in real estate. So you may be thinking to yourself, like, what do you mean? Like, if it's not cash flow, right? Like, how does not having cash flow not create the results you want? And the answer to that is you have to look at real estate investing from a high level, right? There's many different deal metrics in a real estate deal besides just cash flow or cash on cash yield, right? If you actually look at deal level returns, like something like IRR, like, right, internal rate of return, average annual return, equity multiple, right? Those kinds of return metrics rarely are influenced by cash flows, right? I mean, the cash flows certainly help, don't get me wrong. They certainly still create some sort of part of the returns for those. But if you actually parse out, go into Excel and actually literally parse out how much of a factor those cash flows are to, for example, something like an IRR metric or average annual return metric, you'll find it's kind of relatively insignificant as compared to the equity and the sales side of the deal. And if you think about it a little bit more conceptually too, right? If you study some of the biggest real estate investors, empires of the past, right? It's rare that they got rich on the cash flow yield, right? Again, certainly the cash flow is critical, right? You need it there, you need to float your deals. Having extra income is fantastic. But where the real, true legacy wealth, right? Like that stuff that is like, that really just, you know, takes your family to a whole nother level, stuff that you can pass to your kids and even grandkids, right? That stuff is made in the equity of the deal. Now, as I've said before, you can't take this out of context, right? Because as I said, cash flow is absolutely necessary, right? You can't expect to buy a real estate deal and let's say you've got a 5, 10 year, 15 year time horizon of deal, expect to do well on it when you're literally gushing and bleeding cash every single month, right? That's obviously not gonna fly, right? Because you're not gonna be able to survive the next 5, 10, 15 years if every month you're paying to just hold on to the asset. That obviously makes no sense. But that being said, people I think get way overcaught in this idea of, well, I need to maximize my cash flow because that's what's the most important to me. So that's what I'm gonna base my real estate investing criteria on, right? Because again, that's just a very one-dimensional way of looking at real estate, right? Certainly the cash flow, like I said, certainly cash flow is important and that yield is important, but you need to take a look at the higher level picture and really understand the total returns of the deal. In terms of practical execution, I truly think there's a balance, right? I mean, in a lot of my deals that I, buy for myself or raise capital for, right? I mean, there certainly is cash flow, right? I mean, I'm not buying stuff that's breaking even or losing money, right? I'm certainly generating cash flow in all my deals. Even on my syndications, right? I structure it where I usually have preferred returns, right? Because, most people want to see some sort of cash on cash yield throughout the whole period, which totally makes sense, right? And typically my prefs are anywhere from 4 to 6%, which most of my projects can relatively pay out, right? Relatively comfortably pay out. But that being said, right, I think the issue becomes is when people are like, well, I'm only going to invest if I see 7, 8, 9, 10% cash on cash return. And the issue with that is not necessarily their target for it, but then it makes them, chase deals in the wrong locations, in the wrong areas, in the wrong strategies, right? Like they say, all right, well, obviously I can't achieve it in, in a Class A market or even a Class B market. So I'm going to go to a Class C market because that's where I can go maximize my month-to-month cash flow, and they kind of pencil it on their Excel and they see huge cash flow numbers and they go run after that deal. And I think that is the crux of the mistake, right? Because it's not necessarily the target metric you have, it's what you do to chase that target metric, right? So these guys go and buy, in my humble opinion, kind of crappy locations and crappy inventory in order to maximize their cash flow. And that's great. They're making these great month-to-month checks and I'm super, they're super ecstatic about it, right? But again, what you're not looking at is, what about on the exit, right? Like, is it a true fantastic property that's going to command demand and value in 5, 10, 15 years? Is the location a quality location that's going to continue to have demand, growth, right? From a population perspective, job perspective, infrastructure perspective, is it going to command that in 5, 10, 15 years, right? And a lot of times, if you're kind of chasing that cash flow, the answer is going to be no, right? You're probably going to be, pardon my bluntness, you're going to be chasing crappy products and crappy locations to kind of pencil out the best number deals on your Excel sheet. And I really, really believe it is a major recipe for disaster. So what's the takeaway here is be cognizant, right? Don't be on the extreme where you're just so, kind of head-eye focused on one metric, the cash flow, right? Obviously, all investors need some balance, and especially as you grow your investment portfolio, right? You can kind of see where you need a little bit more cash flow, where you can kind of take a little bit more equity upside, right? So it's all a little bit more about balance. So the point is, don't be so narrowly focused on one metric. Remember to look at your investment portfolio from a high level, and then at deal levels, remember to look at them from a high level too, right? Don't just chase one metric. Look at all your metrics, right? Your cash flow, your cash on cash, your IRR, your average annual return, your equity multiple, right? And really understand the full story of the deal, where the return's really coming from, and what you need to prioritize. So hopefully that helps, guys. Hopefully that kind of resets your mindset a little bit about this concept. Again, I'm super, super passionate about it. I really see a lot of people kind of make this mistake about just overemphasizing and over targeting one metric. So if you have any questions, thoughts, if you disagree with me, make sure you put them in the comments below and I'll definitely reach back out.